what I'm going to do is take you through the headline outcome of the report. It was very much set up to address this issue of interest rates, which was bandied around in the press and elsewhere as being a key issue for Green Deal. And when we look at that, we look at the background to it, it was really about saying, can we take away this interest rate issue as one of those barriers, as one of the things in a way that mentally stopped us moving on. A lot of people found it as a reason to talk about it, and a lot of the press got up and said, this is a big issue. So we wanted to know, is it a big issue? And if it is, what do we do to sort it? So we wanted to review it as charged by the Green Deal Finance Company, to share the findings with stakeholders and policymakers, and to support delivery of any other options that might be taken up. And I'll come on to those options as we go through this. Our real aim, though, is to provide an informed debate. Yeah? Let's do this on a fact-based issue. Let's understand the facts behind it. Let's look at what's really happening on the ground. Very much part of the UK-GBC, and I chaired it. But the important thing is we had input from multiple stakeholders. So 16 organisations from the finance sector, from Green Deal providers and others in the delivery sector, from consumer groups and from consultants who've been out doing work around Green Deal. One of the critical things we wanted to do was say, look, this is about large-scale retrofit. Now, we want to know, can we find the billions required? Now, how many billions is it? So I was very interested to see one of the earlier slides from John that we still want to hit these carbon budget targets by 2030, by 2050, and that means finding significant amounts of money. So the Green Deal Finance Company says it wants to lend $3 billion by 2020. Some work which I did with the Energy Saving Trust about 4 years ago now said we need to find 70 billion to improve the housing stock. And E3G, the consultancy and think tank, said we need to find over 100 billion. Okay, not tomorrow, but over the next 10, 20 years. How do we find that scale of finance? That's the question we should be asking, not can we do up 1 or 2 houses with cheaper money. I want to thank everybody in the group, a wide range of group, as I said, from finance to social housing to the delivery sector. And what was really great about this group is we had representatives from across the board. We also had the consumer futures in there, talking to us about the consumer issues. We had Forum on Future there, looking at community groups. So we had a wide range of input. And it was really important to do this. And then it brought in new thinking and new ways of looking at the issue. So, what was our outcome? What do we conclude? Firstly, interest rate is not the real issue out there, but it's not helping. Some small local programs may be able to provide lower rates. Some of the local programs have access to low-cost capital, and it will be a good way to test a lower rate if we still want to get up and sort that one out. But however, if we're going to look at the billions, if we are going to go large scale, then it's about government, I'm afraid. It's about either policy changes and or some form of subsidy, some form of funding required, if we want to bring down the rates. So why are we saying this? What came out of this? So on the first one, we said, look, what about interest rate as an issue? And of course, the interest rate is the interest rate from the Green Deal Finance Company, currently run about 7 to 9% on APR, depending on what you have done and how long you take the loan for. It has to be, by rule, fixed. It has to enable the golden rule to be delivered. And it is collected, as we know, Green Deal through the meter. So that is, if you like, the boundaries around which the Green Deal Finance Company and anybody else might actually fit into. We then said, okay, what about this? What about the rate? And then we of course started with the consumer. And the consumer research says, look, actually, consumers are not overwhelmingly worried about the rate. I mean, one of the best quotes from the team was look, if they want a new sofa, then they're prepared to pay 15% for it. So it's not the fact that the interest rate is high at 7-9%. It's the fact that actually demand is not there to pay for that, to want to pay any interest at times. It's about the underlying demand issue more than the interest rate. We also looked at the Green Deal Finance Company and I looked at their rates, and they'd had some work done by Capital Economics which we reviewed and felt comfortable with, and said, look, on a like-to-like basis, when you're looking at those confines of fixed term, and when you're looking at the confines of the golden rule, we're looking at what others are doing, this is actually a reasonable offer of finance. One of the team members had actually tried to raise some money to do a small, I say small, but £100 million fund for Green Deal. They could not get the cost of money below 10%. So they struggled to find cheap money to go out and do this on a purely private sector basis. And so we think the Green Deal Finance Company is offering a reasonable rate compared to what's available in the market. But there are issues. Yeah? So high rates, maybe the consumer's not totally concerned, but there are some issues. The golden rule is clearly set by the savings that can be made in the house. And the savings depend on the green bit, the charge that you pay. And that charge is set by the interest rate. So the higher the interest rate, the less likely you are to hit the Green Deal. So we heard earlier some of the problems is that the golden rule is not really being achieved on a lot of occasions. Part of that is because an interest rate has to be recovered. And so anything that can bring down that interest rate means more assessments will deliver the golden rule. The second thing on consumer research was less around the interest rate. It's actually how much am I paying back overall? So if I took a loan out for £1,000 for 20 years and paid 8% interest, I'm paying nearly double that over the 20 years. And that is one of the consumer's issues. It is actually £1,000 I pay up front or £2,000 over 20 years. Am I happy with that? And the feedback, and that was on the ground from Green Deal providers, was that is a sort of woe factor when they look at doing that. So part of the concern about the high interest rate is yes, it adds to that payment over 20 years, but also it's the 20-year problem. So 8% over 5 years, you don't pay back twice. 8% over 20 years, you do. So part of it is the need to pay back some of these measures over a long period. So we're saying, look, the interest rate is not the key issue, but there would be some real benefits in reducing it. Initially, some of the research that came out, this is in some of the report for those of you who've seen it, published by DEC on wave 1, 2 and 3, on people who are taking up assessments. They say that Green Deal finance options are not attractive. Only 2 to 3% of people who've had assessments said it was the Green Deal finance rates that put them off taking up Green Deal finance. There are other reasons there, because somebody else was paying for it. Strangely, they weren't offered it. They don't want to finance anyway. They want to pay for it up front. Cash back's helping. So this is quite interesting to research. Ironically, I only came across it, I think it was yesterday as I was reading it, but I thought this was quite a useful piece of research to reflect back what the group was saying and coming up against. But let's, again, focus a little bit more on the interest rate and say, look, let's say that we do see some benefits in reducing it. What are the key issues that actually having it as high as it might be? What are the policy drivers? So sometimes policy, it's rather than the cost of finance, some policy is setting the cost of finance. Fixed term, fixed rate money costs. Yeah, you want to borrow, you go out and do if you're working in project finance, so you want to borrow for 20 years, 25 years, it is expensive money because nobody can see what's happening in the future, and so the market charges for that uncertainty. So anything that in the policy term demands that interest rate is fixed for 20, 25 years is going to be more expensive. That is the design of money. Also on that basis, banks are not very comfortable with it. Under the Basel III regulation, they have to put more equity aside for long-term lending. Yeah? So even if you go into project finance, if you're trying to finance wind farms or solar or even gas power stations, long-term money costs money. Banks are very averse to it. And you're seeing others now coming into that space. So one of the issues could be around saying, could we make it more of a variable rate? Could Green Deal become a variable rate? That will help bring down the cost of interest rate. Now, the golden rule, we've heard that is one of the key policy issues, which when we go out there and we look at some of the alternative projects in products in the market from the mortgage sector or from the banks, they don't care about the golden rule. It's not their issue, they're just lending money. And then lending money against security of the built there. So having the golden rule wrapped around it means that it has to come under the moniker of Green Deal. And thirdly, the Consumer Credit Act. And in case we're not recommending this, we're just trying to inform the debate. The Consumer Credit Act is put in there, as it says, to protect the consumer, but there is a cost in that. There's a cost not only in the complexity of the process, but you have to talk about interest rate, you have to talk about finance. So going back to £1,000 up front, £2,000 over 20 years, you could just sell that as a service. We will provide you an energy efficiency service to your house for the next 20 years at £200 a year, sorry, £100 a year. So you could start moving it from being a loan finance product into being a service product. And we're seeing examples of that in the commercial market, where we've got ESCO services who are just providing an energy service to commercial entities. And we could move that out of the Consumer Credit Act into a service model. Now, of course, there is a huge implications around why we need the Consumer Credit Act in there in order to protect consumers from sharp practices and other such things. So part of the role of this group is to inform the debate, and we thought we'd just raise that as one of the issues. Now, one of the things, of course, is it's quite difficult to test whether a lower rate would make a difference. But we did explore a bit about how we might lower the rate. And first of all, we started saying, well, what about some small-scale initiatives? How might they help actually bring down the cost of finance, and to see whether that has an impact on demand? There's three areas we really looked at. One is a Green Deal provider could provide finance off their own balance sheet. Now, there is one, NWS, who is actually saying well, they will provide a finance at 6%. Now, it's on their own money, on their own balance sheet, they'll get paid back over the period, they'll take the credit risk. Now, the trouble with that, of course, is trying to scale that one up. If I look at the cost of capital of the Green Deal providers, the listed Green Deal providers across the sector, their cost of capital is generally north of 10%. So for them to provide money at less than 10%, they're destroying shareholder value. So it's quite difficult to expect Green Deal providers to provide it off their own balance sheet. But that is one of the options. It could be done at a small scale. Secondly, local authorities. As many of you know, I've done quite a lot of work with local authorities, and they are very much able to deliver low-cost finance. They can borrow at 0.8 over gilts, and they could then lend on to the local people in their population using a Green Deal process. In fact, some of them are still considering that, and that has not gone away. There are some issues around state aid, which with legal advice has said that is probably possible, but it has to go through the more formal clearance. So that is a real possibility that some local authorities may decide to provide Green Deal finance at a lower rate than currently available. And the third issue or opportunity is around community groups. We're seeing a lot of community groups set up, industrial providence societies. You've got Abundance Generation as a platform, who are raising finance to do small-scale wind, to do solar PV, to do biomass, and they are paying investors returns of about 4% on that capital, so a lower source of capital. So that looks like an interesting way to bring one of these in. So a community group could set up an industrial providence society in order to provide finance. The only slight thing to be aware of is that 4% return gets a 30% tax uplift through the EIS schemes. And EIS schemes are only available for renewable energy. They are not available for financing schemes, so that would require some changes. But conceptually, that might be possible if some communities decide they want to step in and do that. Okay, small scale, remember though, we're trying to find the billions. Yeah? So we're not expecting any of these to really deliver the billions that are required to upgrade the UK housing stock. So what about large-scale solutions? Verco, the consultancy, worked with IPPR on looking at how one might finance. What is the role of government in subsidizing the Green Deal? So moving away from policy changes to looking at subsidy. And they came up with 4 approaches. It could be embedded in the Green Deal process by a grant to the Green Deal Finance Company, so helping them with their costs, both the cost of capital and the cost of operation. It could work with the end consumer taking out the loan, or rather like RHI, pay a regular payment to consumers who have done this. It could be an upfront scheme which in effect subsidises the APR, and it could be a mixture of those 3. So there are various different mechanisms that they looked at. The outcome of that is that, so if they were to do 1.2 million homes by 2020, that would cost about 3.15 billion. the cost of the government of subsidising that consumer interest rate from 8% down to 5%, so getting it in within the boundaries of, if you like, the sort of area that people are thinking about, is about 1.5 billion pounds, or it's about 400 million pounds for every 1 billion pounds of Green Deal. That's the level of subsidy we're looking at. It's a fairly chunky subsidy, but that's the sort of numbers that is important to understand if we think that it's important to get down to interest rate. However, also looking at an alternative large-scale solution was to say, let's think about this as a debt product. But what this chart says is that if we take a guess at the Green Deal finance, because it is not open to the likes of me, but we took a sort of guess at the Green Deal finance and said it's about probably paying about 10% return to the investors from the private sector, so the Green Deal providers who put money in up front. And that, we think, is about 30% of their capital. We think 70% of the money is really set by the bond market, because the idea is to issue securities to the bond market. And if you look at the bond market at the moment, using social housing bonds, things like that, we're probably talking of a cost of capital about 5%. Put those together and you get an interest rate of 6.5%, you add in bad debts and other costs, and that gets us towards their 7%, which is their underlying interest rate, which is then grossed up with all the other charges to 7 to 9%. So we said, if we look at that, what's the easiest thing to subsidise in there? Not the bond market, because that's where we want long-term money to come from. What about subsidising the bottom part, the 10% capital charge that is paid on that capital on what is known as the junior debt or first loss layer? So what happened if we put government level money in there? So we put a 4% cost on that bottom layer rather than a 10%. And that 4% cost could come from central government, or it could come from local authorities, as long as they worked on a collaborative programme. Because if they worked individually, they would find it difficult to access the bond market on their own. Now, we know that's possible. Part of the work we did last year, funded by the Sainsbury's Family Charitable Trust, looked at the way of working on a collaborative banking warehouse. So we know that's possible. But either way, what we reckon is that we could bring down the APR by a couple of percent. So working on 5 to 7% rather than on the current 79%. But it does require that government to put that bottom 30% into the Green Deal financing package. That means that for every billion out there, there is an increase in government debt of 300 million. Now, bearing in mind there's lots of talk of trying to reduce government debt more and more, it's one of those things that people would have to look at. But what is different about this government debt is that it is backed by an asset. It's got cash flow against it. So normally with government debt, you borrow money and then you hope future taxpayers pay that back at some stage. This is cash investments which would have identifiable cash flow through Green Deal repayments coming back. One can go beyond this and say, actually, rather than having government debt in there, we want a government guarantee, because roughly that's the same thing. Now, how that isn't treated in the national accounts is still a bit opaque, but that's one of the things we think it's worth exploring further, is how you use guarantees rather than actual cash in that junior debt sitting there on the bottom. So, let me summarise. Interest rate is an issue, but it's not the biggest issue in the lack of demand. We think there are other issues out there which are more important to address. It does affect the ability to hit the golden rule, and there is this issue around the consumer looking at the total payout that they have to pay. We think it would be very useful actually to test local solutions, whether it's local authority, whether it's community, to see if a reduction makes a difference in take-up. And we believe we can have interest rates a couple of points below that. If that says, yes, it is significant, then there's a couple of options. One can look at the policies that are driving the high interest rates, or one can look at a subsidy or indeed an infrastructure guarantee to underwrite that.
Thank you, Christoph.